Yeah.
So the narrative's different. It's like how do I do enough with a little? Now it was before it was like how do I grow as much as possible with my cash? And now it's like how do I grow, but how do I conserve my cash long enough that I can actually make this work and make this be a profitable company? And really that's
Hey, everybody. Welcome back to another episode of the Richer Geek Podcast. Today's episode is brought to you by REI Words, your go-to SEO agency for increasing traffic to your website. Check them out at reiwords.com. Today, we welcome Kevin White, co-founder of Exbo Group. They started in 2017. He's helped provide finance, operations, strategy support to growth stage companies and M&A diligence support to fund managers. He focuses on bridging the gap between investors and founders, helps CEOs build premier finance functions that appeal to investors. Area of focus is education, software, e-commerce. How you doing, Kevin?
great. And thank you for having me on.
Absolutely. So, I always like to get the background of who we're talking to. Um, where are you from? How did you get to the point where you co-founded Expo Group?
Yeah, I'll give you the journey. So I grew up, we're Expo Group, we're based out of New York, but serve clients nationally. I grew up not far from the city, grew up in New Jersey, mostly northern Jersey, kind of bopped around a little bit. Went out to school in Pennsylvania and then came back. And when I came back to the city, I started working for Ernst & Young, and I worked there for the better part of a decade, a little bit over a decade. The first part of my career was in sort of the ops strategy, which at the time I think a lot of people felt very boring, and now I'm insanely grateful for because it's like a critical
Mm-hmm.
cornerstone of running my business. And then the sort of second half of the EY career was in transaction services and M&A, which was a really good experience in terms of just sort of learning how deals work and understanding what a good financial model looks like, and all that good stuff. So yeah, worked at Ernst & Young for a long time, got my MBA at Columbia. And then during my time there, I ended up working for a venture capital fund called Rethink Education. And Rethink was a $500 million fund, a VC fund based out of New York. They focused on a lot of like Series C through Series B fundraising. And yeah, I really focused on sort of investment sourcing, and sort of strong, finance fundamentals as we were sort of assessing different investments. But pretty quickly, it sort of became apparent, having had been a lifetime consultant, it just kind of became obvious to me that the portcos could use a lot of help. And actually, some of my time being spent supporting, a Series A fundraiser, Series B fundraiser of an existing investment actually like paid huge dividends in terms of investment on time. So I did that. I started helping one of Rethink's portcos just sort of getting their financial act together for fundraising, and it worked really well. The partners of the fund were like, "Hey, you should do more of this." And I said, "Well, that's great, but if I do, it needs to be as a separate entity, and the companies need to pay me, not the fund, because if you're installed there by your investor, you're a watchdog, right?
Yep.
But
Yep.
if you're working on their side of the table, that's a very different situation." And so it worked really well. I started doing it. We didn't take any money from the fund, but they sort of seeded us with an initial portfolio of clients that we could actually take on. And yeah, and then we bootstrapped from there, and now we're 50 people across the US. We've got a team in India as well. And yeah, we grew out of the ed tech investment industry, but now we've really expanded to health tech and enterprise software and business services. So yeah, it's been quite the ride.
Yeah, I can imagine. So, let's get into, I can't imagine some of the differences of the seed stage of what the VCA landscape was 2019 to maybe just after COVID, probably maybe exploded a little bit in 2022. And now we're in a whole other, it's like, man, it's like, can we get a break? It's like COVID,
Yeah.
then this, and interest, and take us through what you saw then and some of the challenges, or are there no challenges? Is people just they're still seeding capital now.
There's still capital out there. Obviously, it's much more challenging fundraising environment than it used to be. And we've got a we work with a lot of funds, and then we have our own portfolio of clients. And so we have a lot of insight into what works and what doesn't, and sort of how the market's gone. What I found, thinking back to 2021, 2022, people can remember
Mm-hmm.
that there was like a free money giveaway party, right? Like everyone
Right.
remember, if you were working in DC back then, there was just this huge bounce from the pandemic that took all these tech companies, like Zoom blew up, and
Mm-hmm.
all types of information sharing companies. But yeah, the really at that point you could go out and most people sort of would fund your seed idea. And then the party ended in 2023, really, the end of 2023. And then the first half of this year, it's been quieter, but starting to come back a little bit.
Mm-hmm.
At first, in 22, seed stage funding actually became more available. So going into 2023, as things started to sour a little bit. And the reason is that valuations at the sort of, I'll call it the mid-size VC companies, which might be series B, C, D,
Mm-hmm.
they dip so low that I won't have to do a down round. And so what a lot of the bigger funds, Insight Partners and Sequoia, ended up doing is they switched to making more seed investments. They did follow-ons for their existing companies in order to extend the cash flow where they needed to. But then they started to make a lot of seed investments with the thought of, hey, if I put some money down here, this company will then have some time to grow and get traction and sort of can turn around when things get better. And that did, so there was a little bit of a tail of an extension of where you can get a lot of seed money. Unfortunately, I would say that has also ended at this point. The interest rates have just remained elevated for too long. And the reality is the money at the LP level at all of these funds is now scarce, right? Because of the liquidity at early stage VC has been so poor, and everyone's trying to do secondaries to get cash out of the funds. There's just not as much investment going on in general. And what that means is a lot of the investments have focused on keeping alive the existing portcos, right? So as opposed to going out and hunting for new companies, they don't want to lose all of the money they've sunk into, whatever company over a 4-round period. So they're very focused on sort of keeping those alive and not taking like a huge write down of their existing portcos.
Mm-hmm.
The good news is, the growth equity side of things, while has certainly quieted, is starting to tick up. So if you're a cash flow positive company, there's still quite a bit of activity and M&A activity, fundraising activity. And then on the VC side, we have seen some sort of glimmers of light at the end of the tunnel with a lot of this stuff too, where, more, and the barometer I always use is how many inbound companies with about 2 million plus of investment are coming and talking to us. That's probably the smallest client that we take, right? Something, $1-2 million investment would be very small for us. In 2022, we must have had 100 inbounds from companies like that, right? Some of which we worked with, some of which we didn't. But it was plentiful. But then that really, all those sort of seed companies, they really went away because not as many new companies were getting funded. But I would say the last, really just toward the end of Q2 this year and going into now over the summer, I've noticed, quite a bit of seed investment taking out again. And the funds that were able to raise additional capital from LPs, they're now, during this difficult pandemic time, that money is starting deployed, and that's getting deployed to more companies as it has to. So yeah, that's, it's definitely been a cycle. I think that until interest rates come down in a meaningful way, we probably won't sort of see the consistent 2020, 2021 levels of investment, because there's just, you could go and invest in a venture capital fund, or you can go and invest in a fixed income security and get 5%. It doesn't really make sense. So
Yeah.
that's how it's going.
Yeah. I get it. In my world also, it's just hard because it's, you have the sellers and the buyers, and they both have different ideas of what an asset should be worth. The sellers want the 2019 numbers, the buyers want the 20,
That's right.
and because the interest rates, the DSCR, it just doesn't cover it, and it's just like, how can we deploy the capital now? So it's kind of a waiting game on a lot of sides. And until, like you said, the interest rates go down, it's like, how can I buy something, when it's there's negative DSCR.
Yeah.
Um,
Yeah.
so let's go back to, we kind of talked about your group, the Expo Group, but we didn't really hit about exactly what is it that who is Expo Group?
Yeah, sure. So, as I mentioned, we really started as a company sort of supporting that, rethink education support goes initially, but have grown pretty substantially then to do several different things now. I would say there's still two core branches of our business. The first is CFO and controllership advisory work. And so that can come in a lot of different forms. If it's a smaller company, and smaller for us is like sub $10 million of top line, we're usually the entire outsourced finance team, right? We're the accountant, controller, and CFO. We're everything.
Yep.
Once you get past that point, we tend to play a more specific role because usually at that point you want to hire someone in-house anyway. But because we have a lot of institutional knowledge and our team's talented, we often will stay on with the CFOs in a capacity, either one, taking over just controllership responsibility, because you might hire a CFO in, really wants to do the financial model, board materials, be very strategic, but isn't necessarily interested in the debits and credits and wants, talented support with that. So we'll handle that. Or we will sort of act as the crack FP&A team for the CFO. You have sort of an office of the CFO where, we're really supporting a lot of the strategic work they're doing in terms of budgeting, fundraising, forecasting, board reporting, KPI packages. That's pretty common. It's very common with growth equity funds that are going in and maybe they buy a company called $60 million top line. What'll happen often, and we work with big funds, like multi-billion dollar funds doing a lot of this stuff. When they make those investments, the existing CFO at the mid-sized company was probably a great person getting the company to where it was, but doesn't really actually have an interest in staying on and doing the 6x as much work that will be required by the institutional investor coming in to actually change things over, right? So, it's not even like a pushing people out thing. They actually just don't want to hang around. And so what we do is a lot of funds that we've done great jobs for and have good relationships with, they'll install us as sort of this bridge, right? Where they come in, we take what we need from the CFO, we create a new financial model, create an industrial, strength, a KPI package, and then do some of the board reporting. And then by the time the new CFO comes in, there's already a really solid FP&A foundation in place. And then often we'll continue to work with that CFO to help them do things, but at least we got the company over the hump through the acquisition. So that's side one. And then side two is our transaction advisor group. And so that really focuses on tax due diligence and financial due diligence. And it's mostly working directly with the funds themselves. So, you have a private equity company, they'll go out, they'll have a roll-up strategy. We'll do the quality of earnings for all the acquisitions. Also, if there's an add-on strategy and they're consolidating all of these targets into one company, we'll also help do the sort of post-close integration work to actually get them onto NetSuite or whatever it is, so that, again, they have a really strong foundation for finance. Frequently, as many people who invest or work in sort of the middle market space know, a lot of the accounting's messy. These companies, because they're unaudited, right? Or sometimes the bookkeeping's been sort of half run by the founder for 15 years or whatever it is. Right? And so often what we'll do is when the acquisitions happen, we'll transform the company to have like GAAP-based accounting that's auditable, and then we'll consolidate it onto whatever parent code that they have. So we're kind of like a little bit of a Swiss Army knife for these PE companies in that sense. And a lot of the times we'll work on both sides of the table. We'll do the transaction work, and then they'll say, hey, this person could really use some FP&A support going forward post-acquisition. So, it's a little autocatalytic in the sense that we're able to cross-sell these services.
Yeah, it's you know, what, I'm thinking about, you have all this VC, you're looking at all these I keep kind of going back to the economy a little bit. These people that are raising money, how are they changing tactics? Because you had a free for all
Yeah,
basically, and now you don't. Um, is the pitch a little bit different, or how are they? What's the change as far as tactics?
absolutely. Yeah, very different. So, and I can give you perspective. So, in when we were supporting fundraising with our clients in 21, 22, um, just to give context, like you come up with a financial model, you do a three statement projection, you do your P&L, balance sheet, cash flow statement,
Mm,
and you get comfortable with what that forecast looks like.
hmm
And sort of the output, besides being the high level KPIs that you'll run with potential investors through, is also the cash runway. And so in 21, 22, usually what you'd see is a big burn of cash and then another raise and then a burn of cash and maybe
hmm
another raise and then reaching, in year 7 or 8 or who knows, reaching sort of this inflection point where you're actually achieving free cash flow. And that was okay back then because everything was about increasing your revenue as much as possible. So
hmm
long as your model showed that you had strong revenue growth, and we usually like the unicorn was the 3x twice and then
Yeah,
2x three times, right? So
yeah,
that's what everyone always told you is what you wanted to do. And look, some models we had were showing that if we thought the company could be big, but the point is you just wanted to show as much revenue growth as possible and paint a picture that that was feasible based on the cash investment.
hmm
So if I'm gonna increase my ARR by $80 million, how am I doing that, right? Like how many sales professionals am I hiring that are driving, X amount of sales targets or Y amount of new contracts? You're painting a picture in that model of like, yeah, if I have this cash, it is reasonable to assume if I hire these salespeople this time and structure my organization this way, I should be able to drive to this number of revenue. And so it became this sanity check where could you achieve these revenue numbers? How are you thinking about it? And if you had a very well thought out model, the fundraising would go pretty smooth, right? Back then, it would, so long as you could show good revenue. Nowadays, nowadays, revenue obviously still very important. A lot of people talk about burn multiple, how much cash you're burning, and to sort of grow the company. Um, but at now, and those sort of that output piece, that cash piece, everyone is showing the point. There is no second fundraise, right? Everyone is showing direct path to profitability pretty much right off the bat. So someone will sit down and they're like, okay, how many months until you achieve profitability? It doesn't matter if you're a $2 million top line company or a $50 million top line company. That's what everyone wants to see now. So if you're a $2 million top line company, they still want to see some sort of path in a 24-month period, hopefully, that you're actually able to start generating cash and not actually have to go back and fundraise again.
yeah,
So the narrative's different. It's like how do I do enough with a little? Now it was like how do I grow as much as possible with my cash? And now it's like how do I grow, but how do I conserve my cash long enough that I can actually make this work and make this be a profitable company? And really that's the picture that you have to paint now. And you want to get off the call and have the potential investors really believe like, okay, they really could be profitable in 18 months.
hmm
I can see that based on these hirings, based on these revenue targets. The growth is reasonable in this market. It aligns with benchmarks that we've seen other clients,
yeah.
that kind of thing.
And are they looking at, uh, nowadays it's like, well, they want the founder to be a little more experienced.
Yeah.
They're not taking as much risk with newer founders.
Yeah, definitely we've seen a lot of that. Look, it was always the case that the serial entrepreneurs would get the best looks
Hmm
anyway, and it makes sense, right? Like if you've got somebody who successfully did an exit at an $8 million company, and they're like, "This is my next thing," of course, everyone's going to pile onto that, right? So some
Yeah.
level of experience is pretty critical. I would actually say, yeah, for seed fundraising, for initial fundraising from institutional capital, some sort of direct experience, either already running a company or very, very closely tracked experience. Like if you think about like medical devices, right? Like, have you built another medical device before? Really closely
Yeah.
tracked experience with exactly what you're trying to do. That's really it. It's harder to just sort of quit your consulting job and be a founder these days. That's for sure.
Yeah, exactly. Um, on the CFO side, I'm kind of curious, I'm comparing your CFO against your regular CPA, or maybe a mid-sized CPA. What are some of the different tools? Why are you better than a CPA? What is it that you do, and what kind of different tools that you use in order to do the entire CFO job?
Yeah, it's a good question. And a lot of it comes down to uh our teams all ex Big Four, and they're talented, they know what they're
Yeah.
doing. But a lot of it comes down to just price and efficiency too. So
Mm.
here's the thing with finance, there's two sort of personalities, let's call them, right? There's the CFO personality, and that's a person who's either been in banking or FP&A,
Mhm.
and they absolutely love Excel modeling, and they'll get up in front of your board and they'll give the nice presentation, the KPI package. They'll tell you what your budget should be. And then there's the controller, right? Is the second
Yeah.
personality. That person's usually CPA background, understands how to do good balance sheet reconciliations, understands how to review the accounting well to make sure that every single month over month, as you see variances, that they're explainable, and that you sort of have a very good handle on sort of cash going in and out of the business. The challenge is with smaller companies is those two people are rarely the same person, because
Yeah.
they're somewhat different tracks. And so if you start as a CPA and you go into FP&A, great, you might have both of those.
Mhm.
But they're at larger companies, and even the way it's taught, it's really two separate groups. It's like having an accounting major in college or a finance major in college, right? And so a big challenge for these companies, if you want to have a really good accounting department and finance department, if you wanted to do it full time, you'd really have to hire two separate people. There are some people who are willing to do bookkeeping, who also can do financial modeling, but those are pretty hard to find. Most of the time, if you're finding a good CFO, the only thing that they want to do is deal with the modeling board. They don't want to do the debits and credits. And
Yeah.
so the value prop for
Right.
Expo has been, especially these, sub $10 million companies of top line, is that we can essentially put a team together that really equals a little less than you would pay one full-time accounting resource, and they'll do all of it, right? They'll do
Mhm.
the FP&A, so you can kind of use a consulting team to make up one person. And it's a little bit more cost effective because it's less than the salary you probably go out to market to get someone with comparable skill sets.
Mhm.
But that sort of team will actually be able to do front to back everything, all the bookkeeping, all the finance, all the board interactions. And so that's really what's driven a lot of our growth, is just the sheer, it's not rocket science, right? It's just like the sheer math behind it is, okay, well, these guys are doing this stuff all day. They're good at it, and they're less expensive than an alternative
Mhm.
or full-time hire. And so really it kind of sells itself, right? Like we get a lot of inbounds, and the
Yeah.
market comes to us a lot because a lot of people just need the help.
Oh, well, it's just, ladies and gentlemen, you take, my company also, I have a CFO for hire, part-time CFO. And it was, if ladies and gentlemen, if you get to the point where it's like, for me, it was all of a sudden it's like going, I really don't know. I have too much going on. And, with me, it's different hotels, different it's just different assets. And all of a sudden it's like, there's just too much going on. I don't know am I doing it right? It's find your unique ability as a founder and hire the professionals to do it. And it got to that point where I was like, I'm spending way too much time. I hate accounting.
Yeah,
Can't
yeah,
stand it. I'm an economist.
yeah,
And the accountants, it's like the debits and credits are opposite.
yeah.
What is that? And so I was like, find your unique ability. Mine's finding assets, analyzing things. And I got to the point where it's like going, I need more. I need an advisor, not just a bookkeeper.
Yeah. Yeah.
So where does that come in? At what point, kind of like me, it's like all of a sudden I need more help than just a part-time bookkeeper or full-time bookkeeper.
Yeah. Several entry points to go look for someone that I'd suggest. The first is if you are part of a company that's raising money, and whether that's tech or whatever it is,
Mhm.
if you're going out doing fundraising, the first time that you have an institutional investor, that's usually a point that you should bring somebody in. And the reason is because you can raise a friends and family round or angel investors. They'll be pretty relaxed, right? Like you can give them, just send them some email updates and let them know everything's going okay. And that's your board, right? But the
Yep.
second you have an institutional investor, the amount of requests and what they're going to want to see at board meetings almost becomes a full-time job, right? And if you're trying to do that as a founder and then also appease your board, and make sure that you've got all of your projections in place, your board materials, balls start to get dropped. So
Yep.
that's definitely one point. The other piece is that I think a really good CFO does, and I didn't sort of really truly appreciate this till I started my own company, but most of the time when you're making business decisions, they will impact 3 months from now, right? And so like the bigger your company gets, you go from being in a little bit of a rowboat where you can sort of pivot really quickly on a dime, and then all of a sudden you're in a speedboat, turns a little slower, right? And it's a bigger boat, a bigger boat. Sooner or later, if you want to steer the ship, it might take you 3 months to actually make a turn, right? And so what having a good CFO does is projecting enough in the future that you can make decisions proactively so that by the time you get there, the decision was made 3 months ago and then takes effect. So if
Yep.
you're looking at sales targets, you're like, okay, we lost a salesperson. That means that we're actually, or we didn't lose a salesperson and our sales are not what we thought we were. Let's bring that forecast down. All right, well, that means that our cash flow out date just moved up 4 months, right? Our
Mhm.
sales targets aren't there. We had to adjust the forecast. If you take action now, you can cut headcount or reduce costs in order to extend that cash runway back to where you need to be, that you'll be able to get follow-on investment. If
Yep.
you don't realize that until 4 months later, you're in a world of hurt, right? Because it takes, you might have to let people go, you might have to pay severance, you might have to, reduce certain bills, whatever it is. And time is everything. So if you're getting to the point where you feel like you're constantly on the back foot of a lot of these decisions, or numbers surprise you in terms of your P&L, that's sort of a driving factor
Yeah.
to get a CFO to actually help you sort of look forward.
Yeah, and it's just so important, and it's one of those things where at some point you have to spend money to make money and to keep the companies going. And I think that this part of it, the CFO, and ladies and gentlemen, you don't have to hire these CFOs full time. It could be they're working with you. You meet quarterly or meet monthly. They're not the full time salaried people. And like you said, it's like, my God, I can't imagine CFO controller, how much that is. And you guys are a fraction of the cost. And instead of two heads, you have an entire team of experts. So
Exactly. It's hard to find a resource that has the CFO, the controllership, the tax experience, all of those things like financial transformation experience and systems experience. So
yep,
we just try to create, we take all of our different specialists who are really good at those things and sort of put them together to make the sort of ideal resource, so to speak.
yeah, absolutely. Well, Kevin, it's been a pleasure. Is there anything that you'd like to tell our audience that maybe I didn't get to, that's something you feel it's important for our listeners?
I think you covered most of it. It's great. We went through a lot of good stuff here. I think I'll leave on the message of that. The environment's tough, but if you're an
Mhm.
entrepreneur, don't be discouraged, right? There is still capital out there. There are people who care. The types of investors may have changed, right? You might have to take on some more angel investment for a longer period if you can find it,
Mhm.
or you might have to go to sort of a new VC fund that's focusing on C, whatever it is. But you are still in a position where you're able to fundraise even in this environment. And everything can still work if you just sort of put the effort in. So don't
There
lose
you
hope.
go. There you go, everybody. Don't lose sight. And and I won't lose sight either as I'm trying to raise money also. So it's good to hear that. It's Kevin White, co-founder of Exbo Group. Thank you so much for coming on the Richer Geek Podcast.
Thank you, Michael. Appreciate it.